This is Ryan Coombs, Vice President of Research and Strategies at Carty & Company. Here's your weekly market update ending the first Friday of February 2016. The U.S. unemployment rate fell to an 8-week low in January, but created fewer jobs than projected. The Labor Department said Friday that the economy added 151,000 jobs in January. However, 102,000 of those jobs were minimum wage. That brought the unemployment rate to 4.9% with expectations that unemployment would remain flat. Wage growth was stronger than expected in January. Average hourly earnings rose 0.5% last month. Earnings are up 2.5% since last January. There was also a surprise growth in the manufacturing sector, which added 29,000 jobs last month, the most since August of 2013. The labor force participation rate also rose slightly. Worker productivity slumped in the fourth quarter. Employee output per hour decreased at 3% annualized rates in the final 3 months of last year, the most since the first quarter of 2014. The trade deficit widened in December as weaker growth abroad held back overseas sales. For all of 2015, the trade gap widened $531 billion, the biggest since 2012. In fixed income, economists are deviating even more from the Federal Reserve in forecasting how high interest rates will rise, joining bond and futures traders in doubting the central bank's projected policy tightening path. Analysts and strategists in a Bloomberg survey cut their forecast for the Fed's peak policy rate to a median of 2.88% from 3.36% in a July poll. That compares with the Fed's latest forecasts of 3.5% published in December. 10-year Treasury yields have fallen nearly 50 basis points since beginning 2016. The 10-year Treasury is now establishing a lower level of support around 1.85% level, and that originally formed in March of last year. Peak to trough, 10-year Treasury notes currently have their biggest rally since January of 2016. If yields drop below 1.8%, the next support level down is low 160s. If yields increase above 1.92%, the next level of resistance will be 2%. U.S. stocks declined on Friday amid underwhelming jobs data. Disappointing earnings results weighed on consumer and technology shares. LinkedIn Corp plunged 40% after forecasting a year of slower revenue growth, while Salesforce.com dipped 12%. Hanes Brands Incorporated dipped 15% after a decreased 2016 earnings outlook. With the U.S. earnings season more than midway through, about 77% of firms that have reported have beat profit estimates. However, less than half posted better than expected sales. The Citigroup Economic Surprise Index, which is used to describe how economic data performs relative to forecasts, has now created a downward trend channel since early November, falling by 55%. That sums up your weekly market update, ending the first Friday of January 2016. For more details, please visit our information center at www.cartyco.com, and for real-time updates, follow us on Twitter at Fixed Incomes. Thanks for watching. Have a great week.